Welcome back to episode 89 of the Meet Kevin Report. Always exciting to be here. It's also incredible that we're almost at 90 Meet Kevin Reports now. OPEC has apparently, introduced Russia via phone call and Saudi Arabia potentially teasing a partnership between OPEC and Russia, or an expanded partnership between them and Saudi Arabia. Something to pay attention to. Kind of goes into that narrative of that U.S. dollar de-dollarization as a reserve currency of the world and the petrodollar backer. The foreclosure rates are ticking up in the United States. However, while they are ticking up, they're still well below 2019 levels. So I think fears of this sort of foreclosure wave are widely misplaced. Consumers at least starting to show some potential weakness in broad categories like subscriberships over at AT&T or telecommunications. Interestingly, a lot of the T-Coms not doing great. T-Mobile fell 10.4% yesterday, which is crazy. They fell more than Tesla yesterday. They had over $1 billion in free cash flow, but that missed estimates, and they added fewer subscribers than folks thought. Oops, 10.4% decline. Pretty wild. Seagate also missed yesterday on this talk about an extended inventory correction for chips and specifically memory and storage chips. And of course, yesterday we saw the largest rocket ever. We saw that take off during yesterday's Meet Kevin Report. SpaceX called the resulting explanation a rapid, unscheduled disassembly. So now we've got to take a peek at what expectations are for rates and what's going on with the Federal Reserve, because a lot of people have been wondering, hey, we need a Fed update. So where's the latest on the Fed? We'd like to know. So, and I think the Fed sort of plays, the driver's seat of most of what we're doing here, especially when it obviously comes to rate projections and then what those could mean for earnings at companies. So let's jump into the latest that the Federal Reserve has for us in terms of what we should plan for. All right, let's push this button and go. Well, the Federal Reserve is back at it again. Rate expectations are as follows, and after rate expectations, we're going to look at their latest beige book as well as some recent commentary. We'll try to align that up with what we've got going on with warn notices, and what are those anyway? We'll talk exactly about that. But first, rate expectations. We have about a 13.9% market expectation of a pause, which basically means you're not going to get a pause in May. Instead, you're much more likely to get a hike in May and then maybe a pause, which many are calling hike in May and go away. That's hopeful, but then again, hope is not the best investing strategy. Right now, we are, though, seeing market future pricing at 86.1% for a hike to 5.25% in May. Now, this is particularly important because you've had individuals come out like Loretta Mester and other folks from the Fed, Kaplan, and otherwise. Multiple Fed individuals come out and suggest we just need to get slightly above 5% and then pause. This is sort of the suggestion they're making, catching you up to speed here, with the exception of Bullard, who thinks we need to get to 5.6 to 5.7%. 5.6 to 5.7 would really leave us with 3 more rate hikes. That would be a summer of rate hikes. That's Bullard's take. But most Fed officials seem convinced that we just need to get above 5%. Now, since we're at 4.75 to 5 now, one more rate hike actually puts us at an effective Fed funds rate of 5.125, which is above 5%. So technically, a lot of the Fed speak we're hearing now is reiterating that we're going to be above 5% with one more rate hike, and maybe that's all we need to do. Obviously, the next FOMC meeting is going to have a lot of stress around it because a lot of people are going to wonder, what indications are we going to get for the future after May? And that's a rightful question, and we can look at some projections. Do keep in mind that the next Fed meeting is actually coming up pretty close. It's on May 3rd. The meeting starts on the 2nd. The press conference is on May 3rd. Now, what's really interesting is that's 12 days away from now. It's kind of crazy to think, here we go again. We're going to have another Fed meeting on a Wednesday in just 12 days. So after that, we'll have, after the May meeting, we'll have the June 14th meeting and the July 26th meeting. and then we'll have a little break until September. If Bullard has his way, we'll get 25, 25, 25. Most of the folks at the Fed and the summary of economic projections from the Fed, which have always been wrong in the past and always been low, but if this time happens to be different and they happen to be right, we'll only get one more rate hike. Now, what do we see in terms of expectations, and how could these expectations potentially shift the Federal Reserve's rate hiking regime? Well, first of all, we know that break-even inflation yields, which is basically your 5-year difference between your Treasury bonds and your Treasury inflation-protected securities, TIPS, those right now sit right here. And these give you sort of a market's expectation of what's going on with inflation. Clearly, expectations are still trending down. This is good, though. What we really want to pay attention to is that we have this corner over here, a nice downtrend. And, we had a little spike here right before the banking crisis, a little bit of a trough after the banking crisis, but we've been pretty nicely, steadily trending down here. Now, what I really like about this particular chart is we're actually not seeing a de-anchoring of those inflation expectations, which we actually did see in the last University of Michigan survey last Friday. Now, we won't get another University of Michigan inflation expectation survey until next Friday, which will be about 5 days away from the Federal Reserve meeting. And hopefully that 1-year inflation expectation comes back down to the mid 3.5 range where it was. The last survey we got last week shot up to mid 4s. And that's dangerous because if the Fed thinks inflation expectations are starting to de-anchor, they will guaranteed rug pull us and give us many more rate hikes than we could potentially bargain for. Now, understand this chart. This, in my opinion, is the chart that tells us where the Federal Reserve cuts. This chart right here is the 5-year break-even chart over the last 5 years. And the last time the Federal Reserve cut, we were right about here at this sort of red line over here. This is about the end of 2018. It's actually probably closer to like right here. It's probably around the last time the Fed cut. In addition to, of course, the COVID pandemic, when in March we got those dramatic rate cuts, probably right around here. So these are levels where the Federal Reserve has last cut in terms of break evens. And you can see if we throw up a green line over here, let's do that. If we throw up a green line, you can see we've still got some work to do to be anywhere close to where the Federal Reserve has historically cut, but we are getting closer to that 2018 level. So there we go. Keep that nice and straight. There we go. So that's going to put us somewhere around 1.6-ish where we want to see this go. We've had a wonderful downtrend. Yeah, we've had some ups and downs here. The trend is clearly down. However you look at it, it's trending down. It's just going to be, how long is this trend going to take? Where do we draw that trend line? And what do we ultimately get? If we go with sort of an average, we're probably something like this, which realistically, if we then, let's say we're able to extend this out, we're probably not looking at that cut until realistically somewhere around November, December, January before we actually get to that level. But the markets are pricing in cuts sooner than that. And that's leading some folks to wonder, do the equity markets have it wrong? And what we're going to do is we're going to look at these expectations and how they've changed over time. And then we're also going to look at warn notices. Speaking of warn and warning, all of our marketing is ready for moving from the individual courses strategy. We are changing everything over tonight at 7 p.m., which does mean there's probably an extra like 13, 12-ish hours here or whatever, that if you want to get that final coupon before we get rid of the lowest prices, massive price increase, the barrier to entry is going up substantially. We're moving on. And we're still providing value to these programs. We're still doing live streams. We're just saying we're going to do a completely different strategy in terms of pricing. I'm serious when I say it, like if you want the best price guaranteed, now is the time. So check out those programs and consider that link down below. But what do we have right here? So this is the 421 implied overnight rate probabilities chart. And what's worth noting here is it looks like we're thinking a peak pricing right now might actually come somewhere over here in June. So what's interesting about this chart compared to this chart right here is you have a shift. Now, this is the March chart. Okay, so this is March 31. And then this prior chart that I just showed you is the, there it is the April 21, so today chart. And what you'll notice is the peak is actually in the June meeting, the way the market is currently pricing in rate projections. So that does potentially call for 2 more hikes, whereas over here, the peak was in May. So in other words, after the banking crisis kind of turned out to be a little bit of a nothing burger, and now there are expectations that the Federal Reserve is totally willing to sacrifice more bank failures, especially if they're just fringe banks that had risky standards of safety and security, then why stop the rate hiking, in other words? And this is where markets are starting to realize, yeah, the Fed's probably going to be willing to risk more of a banking crisis, which there doesn't seem to be a banking crisis right now. And if lending standards don't really tighten more than expected, then it's possible the Fed is going to hike a few more times. Maybe hike in May and go away is unrealistic. And markets are starting to price that in. And I think that's why, unfortunately, we've had about now 5 days in a row of a negative NASDAQ. We're on day 4 in a row of negative for the Dow Jones. And it does somewhat make you wonder, hey, is this potentially a red flag that, hey, you need to price in higher rate or a higher terminal rate, and maybe we're going to be closer to what Mr. Bullard over at the Fed believes, which would be closer to about that mid-5 range. Something to start considering, and a lot of folks say the stock market has not properly priced this in. Now, when we look at warn notices, and then we'll look at the Fed's beige book, when we look at warn notices, we do get an indication that more layoffs are definitely coming. But I have a problem when it comes to warn notices and layoffs, and I'll explain that. So take a look at this. This is a chart of warn notices, which are basically requirements by by the government, but from larger companies to give a warning that there are layoffs coming within the next 60 to 90 days. And as you can see here in blue, the summary, the white line is jobless claims. The blue line shows you warn notices. And you can kind of see an inflection right here. And right where there was an inflection where warn notices started accelerating, we kind of slowly started seeing claims trend up as well. Well, now those warn notices are really starting to explode. And that's leading to a lot of fear that we're about to see a big wave of unemployment numbers that just don't look that great. Now, we've been adding fewer jobs to the labor force every month via the employment surveys, but we're still vastly positive, still averaging over 200,000 jobs per month net gained, which is interesting because as a lot of people like to say, hey, layoffs are terrible. Oh my gosh, if people get laid off, then they're not going to be able to function and GDP is going to go down, right? That's traditional wisdom, is that GDP goes down in layoffs. But the reality that we ought to consider is, well, those people probably aren't going to sit idle. They're going to get another job. And if they're more productive in that other job, then GDP could actually go up in layoffs. So it sort of depends. Are we net seeing people struggling on the side of the street who used to be finance or tech professionals who just can't get another job somewhere else? Or is this just all a big rejiggering post-COVID? That's a big question people are asking. Of course, the biggest driver of the Federal Reserve's decisions is going to have to do with inflation, and that's where it's useful to look at the Fed's beige book. So I'm just going to point out some highlights from the beige book. The beige book just came out a day and a half-ish ago. I think it's worth looking at some of the nuance in it. It's nothing massively groundbreaking in terms of earth-shattering news, but it gives you the perspective of what the Federal Reserve is paying attention to and where they're really kind of struggling to debate, okay, like, should we pause after one more hike or are we going to keep going? TBD. So here's sort of your overall view. 9 districts reported no or slight change in activity. 3 indicated modest growth. So you've really gone from everyone expanding substantially to 3 having modest growth and most being flat in terms of U.S. districts. Consumer spending was generally seen as flat. Tourism and travel picked up across much of the country. Manufacturing flatter down, residential real estate and sales softened modestly. But do note that some prices have started to somewhat trend up when it comes to residential real estate. Some folks are suggesting that's because maybe the worst is already behind us in terms of residential real estate. Labor markets show a slower pace of growth than in recent reports. This, to some extent, is good because we don't want to see a wage price spiral. But really, even mentioning the wage price spiral right now is so dated because really there are no conditions indicating we're facing a wage price spiral. So really, if you hear people talking about a spiral coming online, it's misplaced. There's no evidence of it right now. So here you can see kind of a breakdown of various different regions where we look at Philadelphia, Cleveland. You can see that wages and other cost pressures continue to ease. Wage growth slowed to a modest pace. Prices grew in Richmond at a strong pace. So notice how we have these various different results. It's like the entire country hasn't yet hit that softening, right? But most areas, look at this. Atlanta, pressures eased. Chicago, prices and wages rose moderately. San Francisco, demand for retail goods softened. Residential commercial real estate activity fell. Outlooks were largely negative in Dallas. Kansas City saw no pullback in CapEx expenditure plans for companies, and didn't see a pullback in planned wage increases either. Worker retention was higher, even as wage growth slowed. So you're seeing this sort of mixed economy, right? There's no smoking gun here that we're definitely going into a recession, and there's no smoking gun that inflation is definitely gone, although most evidence is pointing to inflation being mostly gone. But there's certainly no evidence of a wage price spiral. We do have somewhat of a mixed picture here. Minneapolis, prices were steady and wages rose slightly. Like, none of this is suggesting that we need to get Paul Volcker rug pulled, right? None of these summaries here suggest that kind of pain. What I enjoy here is Boston noted that cost pressures abated noticeably. Sharp declines in the cost of raw materials and significantly lower freight costs. On balance, the outlook called for further easing of price growth for the remainder of 2023 in Boston. This is good. We want to see that disinflation at effect because it means the Fed has to do less, right? And that's good. We want the Fed to potentially have to do less. Inflation pressures moderated somewhat, but remained widespread, is what the New York area tells us. Okay, so less pressures, but maybe somewhat still sticky. What do we have in Philadelphia? Firms reported that prices continued to rise moderately. However, they noted that the rate of price increases appeared to be slowing. This is good. The Fed should take solace in that some of these numbers are actually starting to look good, right? What do we have in the Cleveland district? Some manufacturers said they continue to raise prices to, quote, catch up from cost increases over the prior 2 years. Similarly, some retail contacts reported selectively raising prices to cover higher costs, although they did so cautiously. So you're getting this more like timid price increasing, right? Remember when we read the Olive Garden, the Darden's earnings call? What did we find? They're like, hey, we raised prices, but not all the way, like not as much as inflation. There is a point where people stop paying. Demand is not unlimitedly elastic, or rather it is elastic. In other words, it's responsive to prices, right? So in other words, there's a limit to how much people are going to pay in plain English, right? There were some reports by firms in both sectors. See, here it is, that customers were starting to push back on further price increases. This is the Richmond one, which actually had probably the most sort of aggressive summary at the front, except now they're starting to also notice the customer pushback. Buyers were reportedly winning more concessions compared to the past 2 years of a take it or lose it price environment, says Atlanta. Chicago tells us producer prices rose modestly. Shipping costs had slowed noticeably. Consumer prices generally increased due to continued elevated demand and pass-through of higher costs. So a general still trend up of inflation, right? You're still seeing prices go up, but nobody's talking runaway inflation, which is good. So it's getting closer to suggesting the Fed might be in the right place. Still work to do though, right? We're not seeing all of these districts complain about prices declining. In that case, you'd be more in a position where the Fed might be prone to pivoting and cutting rates, but we're not seeing that yet. The economy's actually still holding up pretty dang well. So we're kind of in that sort of uncomfortable middle ground where it's like, things aren't bad enough for the Fed to do anything. Inflation is slowly going away. It's taking longer than expected, which means we're probably just going to have to deal with higher rates for longer. What do we have in the St. Louis district? Overall, contacts project increasing prices, but at a slower pace compared to prior quarters. Yeah, I mean, this is so far very consistent with the Fed giving us certainly another 25 BP hike and playing a little bit more wait and see. Now, the wait and see for the next period, that is for May, we're not going to get another inflation report. I don't even think we'll have time for another jobs report. In fact, if we look at the BLS schedule of releases here, we're probably not going to get another jobs report. And I don't think we are. The next jobs report, right, because that's on a Wednesday. So no, we're not going to get another CPI or jobs report. The next jobs report is on the 5th. And then we don't get inflation until the 10th and 11th via CPI and PPI. And the next Fed meeting is the middle of June. So we've got, somewhere in June 14, 15. So we've got some time. That's actually, that's interesting. CPI is on the 13th in June. So for the June meeting, we'll actually have 2 inflation reports, whereas for the May meeting, we'll have 0 more inflation reports, just the data we already have. Businesses said there's some difficulties with passing along cost increases. Most indicated that they expect prices to increase further over the medium term to rebuild profitability. So you still have that tendency to, okay, we're still going to raise, but not as high as we previously saw. And you kind of see that reiterated in both Dallas and San Francisco and higher final prices, although again at a slower pace. Okay, which all of this is very consistent with the Fed is close. Little bit more work to do, but we're getting there. And so where do we sort of bottom line this when it comes to the Federal Reserve? Well, in my opinion, we are set in stone for a 25 BP hike May 3rd, unless something crazy happens. After that, we're going to get 2 CPI reports before we hear from the Federal Reserve again. That means those reports, CPI and PPI, as well as the Fed's preferred PC, all of those reports need to come in soft. If those reports come in soft, they'll dictate a pause. If they come in sticky, we'll get another 25 BP here. So if you're making bets for May, I think it's a foregone conclusion we're getting 25. Then everything is going to be right back on to writing those CPI numbers, which we'll be getting. Now, within the next week, we will be getting the PCE report and that sentiment report next Friday. The next Friday report on sentiment is going to be huge because we want to see that anchoring of inflation coming back. Because for the first time in this sort of tightening cycle, we've actually seen a little, expectations are unanchoring a little bit, and that's dangerous. So mark your calendar for 7 a.m. on the 28th for that. And then also 5:30 a.m. on the 28th, we'll be getting the PCE report, which is the Fed's preferred inflation gauge. But of course, CPI has a lot of weight. And so we expect the deflator to come in at 0.1%. Core month over month, though, that removes food and energy, right? The more volatile component, we'll expect that to come in at 0.3. Also, pay attention to oil prices. Oil prices right now are slightly up for the morning, up about 0.4%, but we're still nicely down, probably down a solid 5% from the peak after the OPEC nonsense. And since we've had earnings week now mostly behind us, let's keep our fingers crossed for a nice bullish Friday so we could go into the weekend and not be in that situation where you have the darn stock ticker symbol screeners on your watch or your phone, and all weekend you're just like, yep, still down. We don't want that. So with that said, what are the expectations for the Fed? The Fed's actually, and it sounds crazy, it sounds shill-ish to say it, but they're kind of doing their job, and they're starting to succeed at it. Inflation's not running away. There's no wage price spiral, and the economy's still strong enough to where we're not in recession. So far, it's best case scenario. Will it hold up? Nobody knows. We do know 7 p.m. tonight, we're changing all the prices. So cheers to that, and don't sue me, bro. All right. So let's go back to the next topic. I'm down to respond to Steve here for the next topic here. So somebody says, "Can you move a little bit on the left?" Can I move a little bit on the left? Oh, I think you were talking when I had a chart up, eh? Yeah, we'll do that next time. So, let's see here. Okay. Yeah, I'm down to respond to some of these things. Always appreciate your all's questions and insights, and I'll give you my opinions. Which remember, like my goal, whether I'm right or wrong, is just to give you perspective. And obviously, I do everything in my power to be right because who doesn't want to be right? I mean, even Jerome Powell wants to be right. Whether or not he will be, remains to be seen. So let's see here. How do you get access to the member live stream? Well, when you sign up for the programs and you watch the first lecture, it describes exactly how to get in. So make sure you knock that out. And okay, all right, some good questions here. Let's go ahead and answer some of these. I think it's interesting. So let's talk about this. Well, Steve in our live chat says we're going to have a second wave of inflation after the recession. That's definitely coming because, after all, if the Federal Reserve's SEP report is projecting 0.4% GDP at the end of the year, and now you've got some Fed officials expecting a slight recession, oh, damn, anything they say is going to be worse. And the actual reality is, so far, Steve's been right. Everything the Fed has projected has been worse in reality. So assuming that anything the Fed says is actually going to be better than expected may end up being a fool's errand. Consider the fact that they were hiking back in March of 2022 when inflation was already at 6.5%. That's when they started hiking. But what were they doing at the same time? They were still printing $80 billion of money. They were still doing QE, quantitative easing, right? Why? It's mind-blowing. Well, it's because they thought inflation was going to be transitory. Oh, it was COVID, then it was Delta, Omicron, and war. Okay, those are 4 shocks, but that'll be temporary. Well, temporary ended up lasting a whole hell of a lot longer. Now, maybe it'll end up proving to be transitory, but that'll be over probably twice the time frame that the Federal Reserve expected. So everything's taking a lot longer. Things are lasting a lot longer. And usually that's a good thing, but in the case of bad news, it's not a good thing. So is it possible that when we go into this shallow recession, we're going to end up with a second wave of inflation? And there are a lot of fears that the answer to that is hell yeah. I mean, look at what the bond market is already pricing in. The bond market, for some reason, expects some massive fear coming very, very soon. I mean, look at it right here. The bond market is screaming at you, telling you, the bond market thinks something's going to snap very soon, which is kind of weird because things don't seem that terribly bad right now. But the way you would read this is you would look right here. Look at this. If the peak Fed rate, which is just where this orange bar peaks right here, is in June, why is the market pricing in all of these cuts? Well, it assumes something is going to break. In fact, you could look at this Barclays piece, which tells it to you in a different phrase. Rate cut expectations right now are being priced out. However, the implied rate path remains far below the Fed's consensus. This looks rather strange, given the market is pricing a further rate hike in May, implying the bond market must be expecting a material deterioration in the economy in the next few months. Looking back at history, and I'll translate this in a moment in case I lost it, but looking back at history, we found only 3 instances of a similar outcome. 1974, 1980, and 1981 all saw a sharp weakening across macroeconomic indicators like the Institute for Supply Side Management information, the non-farm payroll, jobless claims, and inflation. While admittedly ISM manufacturing is already down at recessionary levels, the jobs market and inflation are both in much better starting positions than in these other periods. In other words, this time is different, right? Therefore, we find it hard to believe that we are bearing down on the much anticipated pivot from the Fed to cut unless there is a serious economic weakening. And so this is really interesting because let's translate this. Basically, what these Wall Street suits are saying is, yo, man, dude with the dragon chain armor, listen up, man. The bond market thinks rates are going to tank by the end of the year. The bond market knows all because it has a crystal ball. It doesn't. And because the bond market says big rate cuts are coming, something's about to hit the fan. And then when something hits the fan, the Fed's going to have to turn the money printer on again. And then this is where you get to Steve's argument. Steve, who says, quote, I hope I am wrong. Steve's argument is that as soon as you turn the money printer on again, you're effed because you're going to go right back to the inflation that you had during the pandemic. And I think this is where it's worth considering previous times the Federal Reserve cut. And did we end up getting inflation? Let's consider the Fed's pause in 2018. Did we get inflation when the Federal Reserve paused its rate hike regime? No. We got a bull market and below trend inflation. What about in 2009 when the Federal Reserve provided basically, so to speak, unlimited bailout? It wasn't unlimited at that point. There was a number set on it, but a big bailout, big backstop of markets. The Fed basically created the bottom of the market by a large bailout in February of 2009. This is about 6 months after the Lehman Brothers disaster and everything. Even though Congress was trying to bail, everything out in like September and October, it wasn't until the Fed really stepped in with the money printer. And what did we get for the next decade? No inflation. So it makes you wonder, is structural disinflation, that's a fancy way of saying because we have technology that makes things generally more either productive or cheaper, therefore, in the long run. Like, how much are you paying for a 40-inch TV 20 years ago? That's an LCD, $2,000. How much are you paying today? $200, right? That's structural deflation. Is it possible that we'll go right back to seeing that? And I think where this comes to in expectations is you have to just personally ask yourself, well, what do I believe? And let me set the stage for you because I think it's a lot easier to think about it when we not only consider history, but also when we consider what's likely to happen. So let's think about this. So when we're on this page right here, what we can do is we could say, all right, so what do we know that caused massive inflation? Okay, what caused massive inflation and what caused no inflation? Okay. So if we compare these segments here, we should be able to have a little bit of an idea. So what caused no inflation? Well, no inflation was, let's go with a little bit of a smaller print here. There we go. So no inflation was what we saw in 2018, what we saw in 2009. Some could even argue what we saw in the early 2003 era, because we really didn't have a massive inflation problem. You could also say the late 80s, right? The 87, 89 recession. We didn't have inflation here. That's because this was all part of the Great Moderation. And so no inflation could be because of structural disinflation. That's what I talked about with the LCD screens, right? In other words, we can print without inflation. That's interesting. So what definitely causes inflation? Like, what do we know with certainty causes inflation? Well, let's try 3 rounds of massive stimmy checks, right? Stimmy. Hey, don't get me wrong. I love the stimmy check days. They were great, but it's no surprise we had massive inflation, right? How about massive unemployment payments for not working? Remember the somewhere around $600 a week for doing nothing, right? All of the, obviously the EIDLs, the PPPs, all of this, right? We know that causes inflation. We know price caps and subsequent removal cause inflation. That's what we had in 1969. And then we know, and then somewhere around 75 as well. We also know that inflation is caused by unanchored inflation expectations. This is when the economy gets fed up and says, the Fed doesn't know what the F they're doing, so screw them. When did that happen? Well, you could argue that happened in 79 to 81, where we also had then 2 waves. One wave was over here in 75, and the other wave was in the late 80s. You basically had an oil disaster, right? Oil prices way up. Right? We think oil prices are so high today, but they're really a fraction of what the explosion was that we saw in the mid to late 70s. So really compare the things that cause inflation to what we expect here. So what do we expect going forward? And this is a guess, right? We would expect in a rate cut regime, what do we expect? Do we think we'll go back to stimulus checks? Personally, I believe the answer to that is unlikely. I think what we would see would probably be expanded support for poor and maybe more expanded additional on top of what we already have support for U.S. manufacturing, because that would create more jobs, right? Creating basically providing stimulus checks to manufacturers is what China does. And if you look at China, they're not experiencing heavy inflation. In fact, Chinese rates are kept at, I think it's 2.75%. They're not facing an inflation problem. And the stimulus checks that China gave did not go to the people. They actually went to the creators of labor, which is manufacturing. You know, AOC was on Twitter ranting yesterday that the Labor Department is supposed to be for people and not bosses. But the reality is bosses create jobs. People don't create jobs. People do jobs. Bosses create jobs. Anyway, I don't know why I went off on an AOC tangent here, but then again, she likes to say things that are popular on Twitter that are often detached from reality or economics. Anyway, but she does a great job running campaigns. You can't fault her for that. Even if you hate her guts, you can't fault her. She knows how to run a campaign. So anyway, what do you have? How is today different? And I hate using that phrase because every time I use the word different, we always think, oh, this time is different, you know, and obviously that means that, that's wrong. But I think we have to go a step further here and actually look and go, well, do we really think we're going to get any of the things on the left again that would cause a second massive wave of inflation after this, say, shallow or deep recession that we get when the Federal Reserve starts printing again? Well, do we think we're going to get rounds of stimulus checks and massive unemployment payments for not working, creating massive supply chain disruptions and lockdowns? No, of course not. I mean, nobody in their right mind is going to go back to that. No way. Hell no. Do we have price caps? No, we've learned that price caps don't work. Do we have unanchored inflation expectation? Technically, no. Have we seen a recent crack? Yes. So we want to pay attention to this one. But technically right now, no. Do we have an oil disaster with oil prices skyrocketing? Gas is more expensive now. That's true. But is it anything like the 4x that we saw back in the 80s? Or even what we saw in the 2008 era? No, of course not. Yes, oil and gas is a little more expensive, but it's nowhere near the levels that it even was in this cycle, right? So no, we don't have an OPEC or oil disaster. I mean, we do have new fears, like we have this D-dollar fear, right? So there's the D-dollar fear, but I've already broken down on the channel 1,000 times that this is complete nonsense. I just posted a video on it yesterday. Just type into YouTube, Meet Kevin, China breaks the dollar or whatever. Then you can have this argument about China invading Taiwan. Yes, that's a potential problem, but it's probably like a less than 5% probability. And of course, if you have a different probability, then maybe you think differently. And yeah, we've got the Russia-Ukraine disaster, but so far the world is moving forward, without any massive inflation continuing, right? We're facing disinflation right now. Yes, there's still some levels of sticky inflation, but the point is, if we go through a recession, the current cycle of inflation is expected to be gone. So not terribly worried about that. So what do we think going forward? Well, yeah, maybe expanded support for the poor and additional support for manufacturing. But do I really think we're going to get, after the Fed goes back to cutting, some kind of massive surge of inflation again? No, because nothing aligns with the left side here. Everything aligns with the right side of this document here, which is the 2009, 2003, late 80s, great moderation style money printing. And guess what? No inflation. So thanks, Steve. You just helped me make a 10-minute video. I appreciate you. I feel like you're owed like a royalty here, like a share of this video's revenue, So anyway, with that said, do I really fear massive inflation? No. But instead, what I'm going to do is I'm going to listen to the opening bell.
Chair of Santander, which is now the fifth largest bank in the U.S., people think.
SAP's the fourth free market.
Okay, a lot of good things to say.
And that's on a miss.
No, I mean, Ms. Botine, a rather remarkable person, just comes back meeting with the heads of state of wherever she goes, probably the most diplomat of people. But just saying that, just not understanding why people in America think that Europe is so weak when it's not.
All right, now just to finish that thought up, Gary Roberts says Milton Friedman would disagree. Government printing is what causes inflation. That's not actually what Milton Friedman says. Milton Friedman says it's the expansion of the money supply. We're always printing money, but if we're rolling that money off, then we could actually see money printing happening at the same time as the money supply is contracting, right? So we can look at the money supply. This is an Austrian School of Economics thesis. And so we could look at the money supply. And to some extent, Milton Friedman is correct. However, it's actually the first derivative of the money supply that you have to pay attention to. It's not the money supply itself that you have to pay attention to. Now, that sounds extremely complicated. It makes it sound like I just came out of a math class. Trust me, I hate math. So let's make this very simple. And let's answer what actually Milton Friedman suggests when him or Austrian economists suggest that the money supply expanding will cause inflation. What it actually means is the rate of change accelerating up quickly in the expansion of the money supply, that causes inflation. Look at this graphically. This is the M2 money supply. And what I want you to notice is, see this entire era from here, 1981 all the way to 2020, that entire segment. What happened, Mr. Gary Roberts? What happened from the left side all the way to 2020? What happened is very simple. The money supply expanded. How much inflation did we get? Zero. Okay, like 1.5%. Super nominal. Basically zero. We may as well round it to zero. But what happened when that rate, which was progressing steadily, even through those recessions, what happened when the rate of money supply expansion exploded? In other words, boop, 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 right here, over here during the COVID pandemic. Oh, damn, that caused inflation. So we have to parse what Milton Friedman says. And actually, you helped me make my point, because if we go over here to 2009, you can see the rate of money supply growth didn't unanchor ridiculously and stupidly, and we didn't get inflation. So money supply can expand without causing inflation. It's the derivative of inflation or of the money supply that causes inflation. If I were to make a first derivative chart of this, it would probably look something like, let's draw it together. So if we were going to draw a first derivative chart of this, boy, it's been so long since I've done this. So the rate of change for 20 years is flat, right? This is our chart, flat, and therefore no inflation, right? But then all of a sudden, the acceleration, how quickly the money supply expanded, exploded, right? And then we kind of got back to flat, and then we actually turned negative, right? Money supply growth expanding at sort of a negative level. This right here is what caused the inflation, not the 20 years before it. So it's really interesting to think about. Look, I love economics. And if you want to learn all of my perspectives on building your wealth, check out the program's link down below. We're changing all the pricing at 7 p.m. Tonight. That's when we're flipping over. So you've got another, 10 hours or whatever from when you're watching this video. It might be even less than that, depending on when you watch it. But anyway, 7 p.m. tonight, we're making the changes. The lowest price options will be going away to get into the lifetime access on the programs on building your wealth. If you like my perspective, I'd love to have you over there. Okay. Gary Roberts says touche. Well, I appreciate that. Hey, and no guarantees, right? This isn't saying I'm perfect or that, it's right. All of this is perspective and understanding, I think, right? And everybody's just trying to do their best. But I appreciate you being here. Okay, good. So let's now, there's a lot of talk about the Fed. Hot damn. All right, we've got a few more things that we got to talk about. Yeah. Okay. So, yeah, this is a good one. Okay. It's also an interesting one. So we're going to do a little note here on what's going on with real estate. This will be a short one, but I think it'll be quite enlightening because there's potentially something going on that is skewing some of our expectations. And it's really fascinating. It really has to do with sort of almost a manipulation, dare you say, but it's real. It's happening. So it's not like we're trying to go tinfoil hatty. But there's some interesting data here. So while I pull this up, let's just do a quick peek. How is the market opening today? NASDAQ is sitting at 0.17. Tesla's actually going negative off the open. So you're getting more selling pressure at the open, down about 0.5%. We'll see how the day ends up ending. It'll be interesting. The first 5-10 minutes are always a little funky. But let me get this real estate piece, and we'll take a look and see. So real estate. There it is. Got it. Okay. Perfecto. And let's pull this up. Now, obviously a big deal. A lot of people paying attention to real estate right now. A lot of people wanting to get into real estate as well. So let's go here. Perfect. Okay, let's go. Well, now we've got to talk real estate. Real estate, obviously a massive deal because we've seen home prices peak to trough in many areas of the country fall up to 20% from their peak in May of 2022. Since then, we've actually this week, we've seen real estate prices year over year only down, according to Redfin, about 3%. So how is that possible? How is it possible that from the peak in May to the bottom in December, prices in some areas could be down 20%. Nationwide, prices could be down 10%. And this week, year over year, prices year over year are down just 3%. Well, part of this has to do with prices actually starting to trend up again since the beginning of January. And this is fascinating because if we look at mortgage rates aren't coming down. If you look at the prime credit score at about 740, they've been pretty stable around, 7%, which is pretty wild. All you have to do is Google mortgage rates. Make sure you change your credit score to about 740. That tends to be where you get the best pricing. And then just compare. The 30-year mortgage, the blue line, or the 10-6 ARM have been basically aligned around 7%. And while there have been little ups and downs, we really haven't seen a decline in mortgage rates. So what appears to be happening initially, and this isn't the fascinating part of data that we got to talk about, but initially what appears to be happening is because inventory is so low, so few people have actually started selling. Institutional sellers have not really started dumping their inventory yet. Investors, as a percentage of home buyers, has moved down from 25% to 17%. But they're still out there. You still have a positive number of investors buying single-family homes. So you still got investors buying single-family homes. You still don't have the liquidations from the institutions. And you certainly don't have your move-up market selling because they're looking at their 2.5% rate going, why the hell would I move and sign up for a 7% rate? At the same time, as you have buyers who are basically saying, hey, man, look, that's a great house. I'm going to buy it. And then when rates come down in the future, I'll refinance. I personally think that's a very dangerous thing to do from a personal finance point of view, unless you can afford the payment today going forward, because some people are convinced that mortgage rates are going to come down in the future as the Fed cuts rates. But that's not necessarily what needs to happen, especially if you go into a shallow recession or worse, a deeper recession. And that's because mortgage spreads can widen, which basically means even as the Fed reduces rates, mortgage rates could stay elevated. So there's a risk to assuming with certainty that you're going to be able to refinance lower soon. However, that is what a lot of home buyers are doing today. They're assuming they're going to be able to refinance lower. Fine, it's a risky endeavor. But what potentially is really propping up the home buyer market right now? And why does it seem that maybe home prices are actually rising? Well, of course, it's low inventory. We already know that. There is a risk that a surge of inventory would actually lead to more listings on the market than there are buyers, and therefore potentially sort of an actual further correction in prices. So far, that is not materializing. But what is materializing is home buyer affordability next to what the new construction folks are doing. Now, this will get really interesting. So prep for this. These charts are fascinating. Number one chart, we've got 3 charts we're going to look at, or 3 PDF pages, because this one kind of has 2 charts on it. First, look at home buyer affordability. We know that home buyer affordability has done nothing other than trend down. That's understandable. Home buyer affordability goes down as interest rates go up. Easy. Everybody knows that. Same is true for first-time home buyer affordability. Easy mode. Everybody knows that. That's not a big surprise. What do we have over here, though? Here's your existing home sales decline on the bottom right. We're going to put a circle around this. This is your peak to trough in December existing home sales decline. It kind of looks like an uncertain face if you look at it the right way. And you also see that we've hit a little bit of an inflection point here in January, where prices have started on a moving average to tick up again. This is consistent with what we're seeing in most markets throughout America. Low inventory is driving prices up, along with the expectation that inflation has been conquered and eventually people will be able to refinance lower. That may end up being true. Now, I want to be clear with my biases. Even though I'm a real estate broker, I don't service clients. It doesn't make a difference to me what happens. And even with my startup house hack, our program is market independent. It doesn't matter what state we are in the market. Our wedge deal model, which is, well, look in my house hack playlist videos and you can see, is independent of what happens in the market. It doesn't really matter. So my goal is to try to be as unbiased as possible with this information. But I want to get that out of the way, because sometimes people are like, but wait a minute. It really makes no difference to me. In fact, I got to sell a couple properties right now. So if anything, my bias is tilted to suggesting I want there to be a little bit of a hot spring right now, because I'm putting the property on the market probably in like 2 hours. So anyway, okay, this is chart number 1. Okay, fine. So we're seeing an inflection point here in price. But what potentially is dragging that price up? Now, this is what I think is fascinating. Let's jump on over to this particular chart right here. Watch this chart, and it's going to take a moment to really analyze this chart, but it's a good one. So the blue line is home purchase loan applications. In other words, everybody's going to buy a home with a loan. How many of those people are applying to get a home loan? We're down 39% year over year. In other words, the number is plummeting. Where, folks, however, are people actually projecting higher, or not projecting, where actually are loan applications positive as of March 31st? New homes, folks. New homes. Now, this is really interesting because new homes have a little bit of an incentive to skew prices. This is not trying to bag on new construction home builders. This is just an economic lesson on how the game is played. Okay, here's how the game is played. If you have a property that's in escrow in November and it's going to close in January, well, that property is probably going to get appraised closer to January, probably within 2 or 3 weeks of its closing. That means when the appraiser comes in January for that new home, that appraiser is going to say, all right, I need to appraise this, say, $450,000 new home. The easiest thing to do is look at other new homes. Well, excuse me, what better than other new homes in the neighborhood that are the same type of home? So the same home in the same neighborhood, what better than to look at those that are going into escrow in January that are slated to, let's say, close in March and would get appraised in March. In other words, the appraiser in January is going to look at those new escrows in January. And what they're going to want to see is that, hey, our price is going up. And maybe the prices are going up. In this case, you could justify the comp for your backlog property on the left, and you could sell that property. Now, what we don't always see, though, is not only do we find out, okay, how much did this go into escrow for? We know that. But what do we generally not see? And this has to do with something that builders are doing heavily right now, whether it's KB Homes, DR Horton, Lennar, they're all doing it. They're all playing the incentive game. And what they're doing is they're doing massive rate buy downs as well as construction credits. Hey, you want new flooring? You want an upgraded countertop? Want more cabinetry? Want us to get on our knees? We'll do whatever you need us to do for you because we want to sell this property for $455. We don't want to see the price go down. We want to see the price go up because if the price goes down on the right, you're going to lose your deal on the left. That would be devastating for builders. And right now, there is the potential, based on what we're seeing in the charts, that exactly that is propping up the market. More supply for new construction homes being sold at lower profit margins, though still very profitably, because a lot of these builders bought these lots back in 2020 when land was a lot cheaper. And so they're still making great money. So you have the builders still making great money, giving them more of a capacity to provide incentives, meaning that all of a sudden, what do you have? Well, you end up having higher applications for new homes because the builders are getting on their knees for people. Now, on top of that, just look at the actual data here in terms of inventory. At the bottom chart is the easiest to understand. You're going to see the pink line which says new home share of single-family home sales, relatively stable but somewhat trending up, right? But look at this. New home share of single-family inventory. The inventory is popping off like crazy and has been over the past 3 years here. And so builders are very incentivized to liquidate whatever they can, ideally at higher prices, potentially pushing those medians and average up, setting higher comps for your resale properties. You don't actually have to see the share of sales go up. You just have to see those sales sell at a higher price, propping up the rest of the market. But if these are heavily incentivized sales, it makes you wonder if there is some skew to the data that we're seeing right now, which in my opinion, because we're seeing these applications jump for new homes rather than resale homes, some of it, and we know how the game is played, some of this data could potentially suggest that new homes, which if we jump on over to the first chart I show you, right over here, look at this, new homes selling for a substantially higher median sales price. Look at that, $438 on the median sales price compared to $363 over here for existing homes. Yeah, you've had a little bit of a tick down, but what do you potentially have? New homes driving up the median sales prices in markets because of the way incentives are played. What does that mean in plain English? Well, in plain English, what this means is it's entirely possible that as new home builders are doing everything to preserve their price, we're kind of burning a candle. And if that candle runs out of steam because all of a sudden the incentives home builders are providing aren't actually juicing the real estate market anymore, at the same time as we see a surge of inventory, there is still a risk of downside in real estate prices. Is it a 2008 level? Absolutely not. Do we expect any kind of a foreclosure crisis or short sale crisis again? No. Have foreclosures ticked up? Absolutely. But we're still well below pre-pandemic levels to where really the foreclosure levels that we're seeing right now are nothing that most people with an understanding of what's happening are actually paying attention to, just because we're so relatively low compared to where we were before the pandemic. We could look at that via this chart right here. This chart shows you number of consumers with new foreclosures or bankruptcies, and you can see we're substantially below that 2019 level and the trend that we saw in the prior decade. Way lower. Foreclosures being the blue segment and bankruptcies being the red segment. Yes, they are slightly trending up as the pandemic programs escape us, but that uptrend isn't anywhere close to what we've seen in 2006 and 7, where we had this exponential explosion, or even the pre-pandemic trend. So, long and short of it, the upside risk for real estate is that inventory stays low and people have gotten used to interest rates where they are and they're willing to buy. The downside risk is that prices potentially are being to some degree propped up by new construction, and if inventory ends up surging, we could see a downside risk to real estate. Now, what do I think? What's sort of my take, and how do I sort of average this out, and what expectations do I have? Well, actually, my belief is that we could be in a future real estate regime where prices trade sideways for a bit. and a bit as in a few years. Think about it this way. It's entirely possible that prices end up doing this, but generally trending sideways, even as interest rates come down. The reason for that is if interest rates start trending down, it's entirely possible that inventory comes up as that resale market wakes up. There's also that risk of, institutional liquidations or investors saying, oh, interest rates are coming down, let's sell. So it's possible we could trade sideways. I would say that's probably the best base case scenario to consider now. There's not a lot of evidence that would suggest we're expecting a big boom in real estate prices again, like we saw in 2020 or 2021, though I still think real estate is a phenomenal investment for the next decade. I'm just not expecting this euphoria that we saw in 2020 and 2021. I'm also not expecting a 2008 style crash. So I think generally the base case right now is patience will be a virtue in the real estate market. We'll probably have some volatility. And if we trade sideways, that's probably a good base case scenario. Not expecting an explosion, not expecting destruction. And there's plenty of evidence to point to mostly just a sideways trading real estate market until we get back to a sort of trend of maybe 2000 and the 2019 era. So who knows? But that's my take on the real estate market. Would I be gun shy about buying a home? I'd probably be patient right now where rates are, and I wouldn't go in with the expectation that I could refinance. Do I think buying a home is a great decision in the long run? Absolutely. Do I think you should learn how to get wedge deals in the Zero to Millionaire real estate program? We're changing prices on those up at 7 p.m. tonight. Yeah, I absolutely think you should get into owning real estate and learning how to get wedge deals because you can do that no matter what the market does. Is there a big sign to either direction? No. Cheers. Alrighty, next topic that we have to talk about. There's so much to talk about today. It's like wunderbar. I don't even know that we have time for all of it, but we'll see. We'll do our best here. So next up, let's see here what we have. So this will be the next topic that we go through, and here we go. Oh boy, here we go. All right, looks like. By the way, market's slightly red right now. Yeah, you're still sitting down about 1/3% right now on the NASDAQ. DJI, you're sitting at flat, basically 0.05. No real exciting movement here. S&P also just ticked down a little smidgen. So we'll see how the day evolves. But so far, it looks like it might be a soft red day. That's a bummer, but that's the way the market works. All right, well, let's take a peek at let's see. All right, let's go ahead and hit this topic here. Here we go. Okay, next topic. Well, Cathie Wood has a new massive price target out for Tesla, but instead of talking about 2025, in order to expand the valuation and hit the news cycle, Cathie has decided to move out to 2027. Generally, Cathie talks about 5-year visions, and the 5-year vision has always been ending in 2025, but now that a couple years have gone by, it is time to talk about 2027. And Cathie Wood suggests that Tesla's expected value per share is more than 10 times what the share price is today. Tesla's share price today is sitting at $161.92, slightly trending down today. But what do we have here? An expectation of $2,000 per share. $2,000 per share divided by 161.9 puts us at actually a 12.3x from today's pricing. Now, why do they suggest this? What do their models show? And what do we have in the different cases? Well, here we go. ARK has a model, and their model projects the following. An expected value of $2,000. This is their base case scenario. A bear case scenario with a 25% probability that Tesla ends up being worth $1,400 per share. So their bear case, folks, is that Tesla only 8.7x's within the next 4 years. And the bull case is that Tesla ends up being worth $2,500 or a multiple of 15.5x. Now let's understand potentially why. Tesla's prospective robotaxi business will, according to ARK, be the key driver, contributing to what they believe 58% of the value of the company and 45% of their earnings. That's because they believe that cars will only represent about 62% of the company's revenue at substantially lower margins than robotaxi network. Now, this is interesting because really you're hitting on that sensitivity here of a lot of people talking Tesla down right now because margins have fallen. They're still phenomenal industry-wide, but they fell below expectations of less than 20% gross margin. So in other words, every $100 that Tesla makes per vehicle, their gross margin has fallen below $20 of gross profit per vehicle. And so I think this is sort of a way to sort of defend and suggest, hey, let the electric vehicles sell at a lower margin. But we actually think in a sort of base case scenario that robotaxi is going to massively drive the value of this company. That robotaxi revenues might only be 25%. But because their margins are going to be so high, they'll represent 45% of the company's actual profits and 58% of the company's value. In other words, they believe at ARK that the car business is only going to be worth 1/4 of the valuation for Tesla. So in other words, if we take $2,000 per share by 2027, Kathy is suggesting that only $560 of the share price will actually be because of the car business. So write that out so you could see it. Of a $2,000 2027 target, you're looking at $560 of that would be because of the cars. Whereas it appears 58% or approximately $1,160 per share will be because of robotaxi. So for example, if you think robotaxi is nonsensical, then maybe your price target is 560 based on Kathy's analysis. Plus, of course, a little bit of revenue for stationary energy, insurance, and human-driven ride hailing. Now, I actually think it's interesting that stationary energy storage is so low here, given the explosion recently in Tesla's storage division. So this would be a question that I have for Brad is why such nominal forecasts for energy storage? And it's possible that ARK believes that energy storage will be a growth business for Tesla, but nowhere near to the level that robotaxi could end up being, or just really autonomy. So let's see what other inputs and outputs we have here. So in 2027, in a bear case, Tesla believes that, ARK believes that Tesla will sell 10.3 million vehicles. Wow. Whereas in the bull case, ARK believes that Tesla will sell 20.7 million vehicles. Now, what's remarkable is they've really reduced their average selling prices substantially here. And now this could potentially be a little bit concerning, given that in the last presentation that ARK did, they believed that in 2025, the average selling price per Tesla would actually be $45,000. It appears to me that ARK has revised their models to suggest Tesla is going to sell vehicles a lot less per vehicle than previously thought. However, they're providing substantial revenues because of electric vehicle revenues. We got those. Where is it? Here it is. Autonomous ride-hailing revenue. Now, I think this really assumes that Tesla is going to be able to get to not just full autonomy at a level of 99% satisfaction, but to 100% full autonomy. Because the last thing you want are Teslas using the last hardware set, which is most Teslas, that is hardware 3. The last thing you want are these Teslas being 99% effective, but you still need to have a human driver. Because even Kathy believes that human-driven ride-hailing would be representative of a nominal amount of revenue relative to autonomous. Now, I think that's interesting because Tesla hasn't even indicated any interest yet in getting into human-driven ride-hailing. There is talk about robo-taxi, and there is talk about that next-generation vehicle that could be robo-taxi. But so far, we haven't really heard about that because we're just not at those FSD levels yet. I did notice that in their model, it doesn't appear that they're including FSD revenue, but that's probably because they're baking that into the average selling price. But that actually makes the average selling prices look even worse for these vehicles. So I'm not exactly sure where that FSD is, unless, of course, that's showing up in the ride-hailing segment, which maybe it is. But I think there's a potential flaw in not segmenting out the FSD, so we could see that a little bit more clearly to understand, okay, how much do they actually think these cars are going to sell for, and how much of that could be FSD. Either way, the expectations here about this massive revenue set from autonomous ride-hailing, I don't know what to think about it. Maybe I don't know what to think about it yet because we're in a situation where we haven't yet realized, okay, what does full self-driving without a driver actually look like for Tesla, right? So it's hard to speculate on what this sort of autonomous ride-hailing network could look like when we haven't even gotten to that state of technology yet. Not only at Tesla, but where we have, it's been with a totally different system. If you look at where we have achieved this sort of self-driving, like Waymo, it's a LiDAR-based system. And theirs isn't perfect, but it's pretty good. And in some cases, it drives around without a driver. It's pretty decent. Tesla uses a completely different system. It's vision-based rather than LiDAR-based, more sensor-based. So we haven't actually seen Tesla be able to pull it off yet, with the exception of if you have FSD, you could drive around in your town and go, Tesla can get through most scenarios. And I agree, it could get through 95% of my daily commute on basically full autopilot. But let's take a look at some of the other comments made by Ark here. A recent flurry of progress in AI should accelerate innovation in the autonomous driving industry. In our view, Tesla's vertical integration strategy and Dojo training supercomputers are a key competitive advantage, suggesting that Tesla's plan to expand Dojo by 2 orders of magnitude next year will help the company shorten time between model updates. That's for your FSD model updates. A recent video of FSD software updates or update includes one driver who nearly completes a full ride hail without touching the wheel. The problem is this nearly question, right? When is that nearly going to go away? When are we going to get to without touching the wheel at all? Yes, we know that Tesla has actually now over 150, let's see here, Tesla owned fleet drives more than 120 million miles per day. Right, but and over 1 million miles per day in FSD. We just got information from Elon Musk that we're at 150 miles of FSD, 150 million miles of FSD driven miles, which is fantastic, which is great. Tesla's capital efficiency, of course, the company is one of the most efficient in terms of factory production. We hope that continues that way. And Tesla should be able to grow quickly is the expectation here. They do give us a $6.6 billion contribution to enterprise or to 3% to expected enterprise value in 2027. I actually think that's relatively low. And I think we could see this battery capacity for energy storage really be a bigger percentage of their valuation in the future. But then again, ARK also has the impression, and they may be right, that an electron is an electron, and that really it's not that big of a deal to focus on batteries. You should be focused on where the actual consumer value is, because the consumer doesn't care about the battery. They care about range and function and use. And the reality is they're right about that. Now, here they quote Elon Musk or paraphrase him, suggesting that autonomous ride hailing will probably be the biggest asset value in history. This is very optimistic, assuming that Tesla can pull off their FSD. And I think that's really where we want. See, they even say it themselves. Our simulation is highly sensitive to the year in which Tesla launches robotaxis. And I think that all comes down to how great FSD is. Now, Elon Musk suggests FSD could be 100% done by the end of this year. But then again, we've kind of been hearing that for years now. So I think it still remains to be seen when we're actually going to get 100% driverless Tesla. And at that point, yeah, maybe, just maybe, these projections could be right. But if it takes us another 10 years to get to 100% driverless on a vision-based system, these valuations fall apart. And even ARK realizes that's the Achilles heel in this model. In my opinion, it's better to take out any kind of expectations for robo-taxis. Let that be the icing on the cake, and just look at Tesla as a vehicle provider that also sells software. And for me, those numbers put me well above a $400 price target by 2025. If we get any icing on the cake until or by then, hey, fantastic. And look, I love hearing about these high valuations because obviously I'm a big a fan of Tesla. I'm an investor in Tesla, and I'd love this to happen. I'm just not convinced that we're just ready yet for this. And I do also think that it's interesting here that they suggest in their 5-year investment horizon that the Optimus robot will basically not contribute significantly to Tesla's valuation. In other words, they're projecting no progress on the or on the Optimus. So really, ARK is saying the Optimus is their icing on the cake. I'm saying Optimus and Robotaxi is the icing on the cake for me. I'm just going to look at this as a high margin business that's selling a great product and a great service for their customers. And hopefully that continues. And I agree with Elon Musk that the sunshine comes out in 2024. And overall, I'm pretty bullish. I'm also bullish on hopping over to the course member live stream and reminding you to join me in the course member live streams. Join before 7 p.m. today when we make that massive transition. And folks, we'll see you in the next one. But in the meantime, some pretty cool news there on Tesla. And hopefully you get to participate in this hopeful and explosive growth of Tesla. And this concludes Eric's piece on Tesla. Thanks so much for watching. I got to run to the course member live stream, and we'll see you in the next one. Goodbye, folks.